But first, let's get started on this historic rally. Tom Lee, a CNBC contributor and head of research at Fundstrat Global Advisors, is now joining me. I'm glad to have you on, Tom. The Dow saw a 1,500-point move today, which hasn't happened in a few years. From here, where do we go? Whoa. Today, Morgan, I believe, clearly demonstrates that the market did not factor in the outcome of the election. We would have been exchanging flats if it had. I believe there is solid evidence that many investors de-risked before the election because they anticipated significant social turmoil, etc., as we can infer from speaking with our clients. I believe that funds are being used, but in a manner that indicates a lot of animal spirits in the industries that individuals are selecting, such as tiny caps. I should mention that Qualcomm has released its profits. We're reviewing those findings and will present them to you shortly. We now have Mike Santoli as well. I'm going to go to you on this one, Mike. Whether it's the dollar's appreciation versus other currencies or the general surge in stocks, particularly in industries like steel, banks, and anything else deemed more cyclical and economically vulnerable to greater growth and deregulation, the truth is that we have witnessed this Trump trade in action today. Bitcoin has also increased. However, we have also observed some internal sell-offs in this market. Whether the so-called Trump trade, as it was being framed going into today, would truly work out and unfold had been the subject of much conjecture. What do you think? Well, it's definitely happening, and it makes sense, at least as a first effort. It has primarily been a further push behind some of the trends that have been simmering beneath the surface on the majority of those fronts. Once more, cyclical leadership has been in place for some time. Since the Fed lowered interest rates, yields have been rising, the dollar has remained comparatively stable, and the economy has shown encouraging surprises. Now, it's simply a matter of putting some of that 2016 playbook into practice, and perhaps honing it a little bit in regards to things like moving small caps. Banks are obviously just hoarding the profits. I do believe that the subject of where to begin will come up, regarding values, inflation, deficits, recent economic growth rates, and even investor sentiment. The starting position is different now than it was in 2016. Before the 2016 election, the market was flat for 18 months, but in the subsequent 18 months, we've seen a 40% increase. Animal spirits haven't been sleeping, in my opinion. Rather, this possible policy mix has effectively given them even more energy. At Post 9, let's head to the markets and bring in Tom Lee. Of course, the managing partner, head of research, and co-founder of Fundstrat Global Advisors. The S&P's year-end objective is 6,300. Tom, it's great to see you. I'm glad to have you. You like to refer to them as easy plays or granny shots. I assume that list has simply grown longer in your opinion. It has indeed. However, there have remained about 35 names, all excellent names with appropriate themes. They become a granny shot if they appear in more than one of our 7 themes. I suppose there is more conviction behind their names, higher conviction really. Since they are large-cap stocks, I believe that most people will recognize these names. Today, cyclicals are being discussed. Some contend that there isn't the commodity price support that you might have had in a previous cycle, despite the fact that they make sense and that many are looking to 2016 for comparisons. Is that something you purchase? Prices for commodities, like as energy, are not always necessary to support cyclicals. Materials can also be helpful to some extent. Indeed, it is correct. I would say yes to those. Even while increased drilling results in lower oil prices, I would argue that the future for energy companies under a Trump presidency isn't as favorable as some may anticipate. However, this is a terrific environment for cyclicals like industrials and financials, with M&A, deregulation, animal spirits, and declining costs of money. In the next 6 months, for example, do you believe there is a genuine chance of reflation? The way that markets are repricing shows us that. 1 year ahead inflation is a metric that quantifies what the markets anticipate 1 year inflation will be in the coming year. That has been edging closer. Now, it stands at 3.66%. In the past, it has served as a catalyst for the market to become anxious. I'm not sure if it's expectations or fiscal spending, but markets are beginning to consider it. It might also be that a more optimistic forecast for GDP is contributing to rising inflation expectations. Trade policy is perhaps where Trump Trade 1.0 ran into issues. Do you believe the market will look past his consistent stance on tariffs once we see what he delivers there? Or will everything else, deregulation, lower corporate taxes, balance out any trade weakness? Tariffs and trade would be the first things that come to mind if someone wanted to present a negative image. However, that is the one area where we are unsure about the final policies. I believe that the policy will be shaped in part by the abundance of real-time input that markets will undoubtedly supply. We should anticipate a generally pro-business climate that is also most likely equity-friendly. Regarding the recent rise, multiples, and your profit projections for the upcoming year, where are we at in terms of fundamentals? As the season draws to a close, earnings have been strong. Healthcare, certain commodity groupings, and energy have all had a negative impact on earnings. However, industries like electronics and industrials continue to generate respectable figures. The forecast for the upcoming year should be favorable due to declining financing costs, increasing housing activity, and the possibility of mergers, which would be especially advantageous for small companies. The growth in small-cap earnings has been about 40%, which leads us to the same trades, looking at Bitcoin and small caps and becoming more cyclical over the next 6 months. Why little caps? For the past 5 years, small caps have underperformed by the greatest amount in 25 years. They are selling at a 7p/E discount or 10x median p/E compared to the S&P's 18x. Earnings growth is faster for small-cap companies. Regional banks and industrials make up around 44% of small-cap stocks, which is a larger percentage than the S&P. Additionally, there is a lot of money on the sidelines. Small caps are where it is for those seeking broader expansion. Small caps gain from reduced taxes and regulations in the absence of the tariffs. That's right. They are at the ideal position. This version just corrects grammar and punctuation mistakes, leaving your script exactly as it is. If you want anything else, let me know.